Welcome to Leadership Reimagined, where game-changing conversations are reshaping the world of work. I'm Janice Ellig, the CEO and founder of Ellig Group, Executive Search Advisors, where we are reimagining search through our longstanding commitment to diversity, equity, and inclusion. On today's topic, iconic investing insights for turbulent times, I am delighted to welcome A. Michael Lipper, the founder and president of Lipper Advisory Services, where they provide money management services for wealthy families, retirement plans, and charitable organizations. Often referred to as an icon in financial markets history, and he is, Michael is known for his distinguished career of over 50 plus years consulting with many of the largest investment organizations in the world. Michael is also a managing member, LSF Partners, LP, a private financial services fund, a trustee of the Stevens Institute of Technology Board, and a trustee of Caltech, California Institute of Technology. Famous for the mutual funds that bear his name, he is a regular contributor to the global press and author of MoneyWise: How to Create, Grow, and Preserve Your Wealth. Michael, it is an honor to feature you today as you generously share your time and investment expertise that is sought after by many globally, especially now during these turbulent times. Thank you for being with us.
It's a pleasure to be with you. I hope I learn a great deal from you.
Well, I'm going to get free advice from you today, Michael, which I love. So I want to go back to your own personal experiences, which you describe in one of your many blogs. And this one is titled Roles in Life Rule Investment Decisions. And you begin by saying, quote, I probably learned more about analytical thinking and careful money management from my experience at New York's racetracks than my MBA classes, as well as working to earn my CFA. Can you talk about these many roles and what happened at the racetrack and how you developed your analytical thinking, being in the Marine Corps, a securities analyst, business consultant, entrepreneur to trustee?
Well, I took courses towards an MBA as an undergraduate. I then went into the Marine Corps, and when I came out, I had to make money, so I didn't finish it.
Yeah, like all of us, right?
Great advantage of the racetrack is typically there are 8 or 9 races a day. So that's 8 or 9 different scenarios. The racing form, or at one point it was the Morning Telegraph, published the past performance of all the horses the night before, and I studied each race, sometimes to make a bet, but not necessarily at each time. One of the things you learn very quickly is you can't figure out that race. There's too much or too little talent in the race. You don't have enough data, etc. The second thing that you learn is the betting public makes 1 or 2 entrants a favorite by putting more money in. The interesting thing is, historically, favorites win about a third of the time.
Is that right?
Yeah.
Wow.
So you don't normally want to go with the crowd. The second thing you learn, and this applies very much to life in general as well as investing, is racing luck. Things happen. Most of the time, you don't know it in advance. And the key to that is one should not make a bet with all of your assets on one thing, because racing luck can happen. The third thing is the objective, at least for me, of a day at the track, is to walk away with more money than when I walked in. So there, if you bet carefully, which means only picking ones that make sense to you, all you need most of the time is one winner out of 3 races, because they tend to be longer odds. The final thing is, after each race, you should look at the past performance of the winner and say, why didn't I pick that?
Interesting.
You learn more from your losses than you do your gains.
So you've applied that as a securities analyst, an entrepreneur, a trustee, to really create, preserve, and build wealth.
Correct.
And so those lessons that you learned at the racetrack, you took forward in your life. So can you describe how you were able to learn from some of that and really create the wealth that you've done?
So I tried to replicate the racing form. It didn't really exist for mutual funds. Yes, there was performance only, but it didn't compare with others and didn't compare over time. I read, and then this was death-defying, the Investment Company Act of 1940. That'll put you to sleep.
I know.
But it became clear that the independent directors of funds had to renew the investment contract each year. Historically, they counted on the advisor to provide the data. I saw an opportunity. I went to the major attorneys for the funds and said, you're taking a huge risk. You're making judgments from the judged. Much better to have an outsider do it. Yeah, we could make mistakes, but they'll be honest mistakes. But you'll get it cleaner. And over time, we'll do it better than anybody else because we will do more of it.
So that's how Lipper Analytical and the index funds came about then
That's
in
right.
1973, right?
Right.
When you start. So you saw a void and you stepped into it to provide these mutual funds with the tools, is that right, that they needed to analyze?
Not only looked at performance, but we looked at fees, we looked at turnover, we looked at a whole number of things that weren't generally looked at.
Again, though, you were raising the bar for what needed to be done for these investments, right? And putting a light on what needed to be looked at.
In the investment world, people can accept that you're only going to be right some of the time, but they really shouldn't accept that something happened on a repeated basis that you didn't know.
So like with the horse races, why didn't you bet on that
That's
horse?
right.
You're looking at the mutual. Why didn't we invest with that mutual fund, right? So you're doing a diagnostic.
Yes, and always preserving the right to be wrong.
Always. So that leads me to January 2nd, 2022. You had a blog which was entitled The 2021 Lessons and a New Worry. And you begin it with great humility saying, quote, over the years, I have been forced to recognize that some mistakes in thinking are repeated far too often. So in doing these funds, you were helping to not make those mistakes. But what have you learned from your own mistakes and others in terms of why they are repeated and why aren't there more corrections made to be more winners?
You may not know this, but the greatest religion in the Western world is the worship of numbers.
Okay.
And people use numbers as if they came from the Almighty and number one, they're accurate, which often they're not. But more importantly, they don't measure all the right things. My attitude is the numbers help in only one thing, help you ask some of the right questions. You'll get some answers and you won't get others. But the more answers you have, the greater the reliability of the predictability of the numbers.
So people are reading numbers, but not truly interpreting them or asking those follow-up questions?
Right.
So that's like in everything in terms of corporate America. It's,
yes.
Financials or what's happening, never asking always the question or the follow-up question and then another follow-up question. Is that right?
I mean, for example, as an analyst, when a company increases its share of market, is that good? 90-odd% of the analysts would say, oh, that's wonderful. I would say, why? Often it's because they cut price. And they bought market share, but they then trapped themselves into a cheap price for a long time. So the earnings won't work.
And maybe if they're gaining market share in one area, they may not be gaining it in another.
That's
right? Where they
could. More importantly, if they're gaining market share in an area, they're concentrating in that area. Okay, it's the lack of attention to detail that
and
is
the
critical.
Strategy, right, that
That's
the
right.
company is pursuing, which maybe changes.
And the willingness to admit you're wrong and reverse. There are any number of companies that have ridden a technology, have ridden a philosophy, a sales strategy, right into the ground because by God, they were right. Well, each day you get numbers and the further you get away from your objective, you should be asking questions.
Are there examples in history, maybe going back a number of years, where you look at some of those really mistakes they kept to a certain belief and path forward, watching those numbers and not pivoting, as so many companies now had to pivot during the pandemic, but pre-pandemic? Are there examples you would cite?
You can find it everywhere. Once you start with the big three automakers, they had control of the U.S. auto market. And yet, over time, they lost share to the imports, and more importantly, the high-priced imports. Other examples is something called the Nifty 50, where there was the 50 leading stocks in the market, and that was meant to be somebody's portfolio. Well, over time, a number of those Nifty 50s actually went bankrupt.
No longer on the Fortune 500,
No.
right? History is a great predictor of some of what's going to happen in the future.
History is a great questioner. My experience at Caltech and Stevens, people in the scientific world look at laws as they're always right. In the business world, that's never happened. Okay, they're right some of the time, some more than others. So you always have to be viewing things that, is this the correct move now?
Michael, I'm working with corporations as we do in terms of recruiting executives into the C-suite and the boardroom. Even though we want people to ask questions, and part of why we present always diverse candidates, because we really believe diversity around a table of any situation, decision-making will bring up things that other people will not. Do you see this in your world in terms of the investing, that people will sometimes just all gravitate together on a particular area, or, somebody who brings up a question nobody's listening to? Or
crowds are comforting for most people. They scare me. And that goes back to the track. They may be right, but if they're right, the returns won't be great. If they're wrong, and you happen, by luck or skill, find the thing that does work, the returns are much greater.
Comforting crowds, we have to keep that in mind. And you don't like crowded markets, and you don't like to be where everything is so popular.
That's right. That's a different issue, is if you're trying to decide what to sell. Okay, you have to recognize that periodically crowds can make prices, but you have to identify when to get out. And it's usually when everybody says it's great.
Okay. So you have some strategies on your stress tests, right? In terms of growth versus value and the way you invest. What are those stress tests you use?
There's been at least 3 bear markets that didn't generate a recession. Second, is the recession going to be short or long? Short ones tend to be, a recession is essentially a price move. You just drop the price on things, and therefore you cure. That happens every now and then, but not frequently. Second one would be a longer recession. Now, I believe that the economic cycles are due to imbalances where things are not well managed or not efficient. You can correct some of those in a recession. Unfortunately, you don't correct enough of them, and that's why we have depressions. The thing that's facing us now is perhaps the most difficult, which is stagflation, of a period of high inflation and slow growth. So your sales don't grow, but your expenses do. Are we going to go into that? I don't know, but I think it's possible. And I think in terms of a portfolio, you should have some of your investments thinking about that. Not all, because it may not happen.
So how would we think about that in terms of more diversification of those investments?
Tend to look at the depth of belief. For example, a lot of companies are going to show declining earnings. There are 2 sources of declining earnings. One, the business is declining. The second is you're continuing to invest in a new product or new strategy that isn't right for this market, but you believe, and that's a good bit of the expense that is lowering your earnings. It's that sort of investment that has appealed to me. Now, then I have to make some guess as to whether you're right and when.
Okay, so these are turbulent times.
Yes, they are.
We have the Ukraine-Russia issue going on. We have the supply chain, employment. A lot of people still don't want to go back to the workplace.
The Federal Reserve now is a political body. It can't get ahead of the economy. It's just not structured that way. The PhD economists are using government data to predict. The biggest fallacy of that, I'm sure that every single person listening to this podcast pays the maximum tax that they can, or maybe a few don't. The Fed and government economists use tax returns numbers to describe human activity.
Okay, well, I'm going to remind our audience that you are listening to Iconic Investing Insights for Turbulent Times with A. Michael Lipper. The topics we cover, like today's, are all current, and a new topic with a new game changer is released on the 3rd Thursday of every month. This is a great way to stay current on relevant issues happening around us. Now, let's return to Michael Lipper. With these turbulent times, you're giving us a lot of information about what is going wrong. and I think our audience is looking at, okay, so I'm an average investor. I have money in mutual funds. I may even pick some stocks. What is the best way to balance out my risks over maybe the next 12 to 18 months? Because there are so many uncertainties, but you say that some of those uncertainties will be solved, but not all of them. So, and they may be things that happen with pricing, which will prices will go up, will go down. How does that average investor help themselves to preserve their wealth and invest wisely?
Two different approaches. The first approach is to commit that you'll spend 5 hours a week on your investing. Okay. If you're not going to spend that, the odds on getting any insights are low. The second piece of that, most of the people who listen to this podcast probably work for medium-sized to large companies. That is your biggest single investment, is your job. And that's where you want to be diversifying if you are not a complete believer. I would suggest that whatever they do, they average. Don't put all your money either into the market or into a given stock at one time, but take that amount of money and say, I'll put 10% in, and for the next 10 quarters, I'll put another 10%. Big money is made by long-term holding. The reason that works is you don't get shook out by periodic market declines.
So, but for a young investor, they can be more patient. They have more time. And what about for us baby boomers, or even those that are older, in terms of how to have patience for a longer-term gain?
Today, there are people born that are likely to live to 125 or maybe 150 years. Everybody listening may live longer. So I think you can take a long-term attitude. My attitude is the cyclical behavior is normally a 5-year period. You want to invest beyond the 5 years. I think you, particularly now, want to invest some of your money overseas. Your biggest risk today is the US dollar. It's beating all other currencies. Again, going back to the racetrack, it's the favorite. You want to bet on some other things, not to the exclusion of the dollar, not to the exclusion so that you can have investments overseas. Now, roughly a third or 40 or maybe 50% of the profits, and let me define profits, cash flow, free cash flow is earned overseas of the major companies. So you're doing that now without knowing it. But you're not getting the benefit or the risk of what foreign investors do in their local companies. Years ago, when I was an analyst, I worked for a firm that was very much involved in a European company, and they were pushing that. And I upset a lot of people, which is normal, at a meeting. And I said, why is it that this great company that we're recommending, every day, the local market is a net seller? Well, I was right. Okay. What the locals saw was the company was taking too much risk. So that's the sort of thing. In terms of individuals, I think you invest in yourself. I mean, for example, it's very rare I will have any direct investment in pharmaceuticals because that's a game that's won and lost by the new products. I don't understand that. I will find good funds that invest in pharmaceuticals who have doctors and consultants, et cetera, who are good at that. Stay with what you know. I can assure you I would not be a good investor in fashion stocks.
Sounds like somebody I know in Nebraska who says, if I don't understand it, I'm not going to invest in it, right? So,
that's right.
Yeah. So you would choose to be in the pharmaceutical area, but in a fund.
Correct.
You'd want to be in a pool. And would you suggest that, average investors, I mean, you said also spend 5 hours a week. But if I have a financial advisor, is that financial advisor going to be where I get the best knowledge, or do I need to work on this myself?
You need to work on it yourself. I would suggest that, yes, you should read the financial press, but also you should read the trade press of areas of interest and knowledge.
Buyer beware, be a knowledgeable investor, right? And then in terms of diversification, you're saying some overseas investments. Is that APAC? Is that EMEA, LATAM? Where should we be?
I think you can be in any of those places in the right companies, the right managers. If you want to do a top-down, I would look for where the education is producing, which tends to be in Asia. I would tend to look at where there's population growth that can get jobs. Again, in Asia. Long-term, it's Africa. Okay.
Oh, interesting, yeah.
Okay, I mean, so it's you have to have a focus to look.
So what are some of those disruptors that we should be looking out for? in terms of how we look at our portfolio and preserving wealth?
Right now, we talk about the supply shortage. And I think that's miscast. I think the real shortage is capable executives. Leadership is poor. The people who are executives now have managerial skills and very definitely political skills, but they're not great teachers. And this is why I think you're going to have problems with the unions. We used to be in a business where in annual reports of company after company, within the first page, they said, our biggest assets are our people. We're not seeing that now. The frontline people don't feel that the leadership is going to look after them. This is going to create changes. Those are the things to be looking at.
So investing in a company, too, is really looking at who's that leader at the top and
That's
following
right.
his or her actions, investments, strategies, what they're doing, correct?
And they may be brilliant, but they're not able to translate it to the foreman. Okay, we cut out a lot of supervisors because the accountants told us, well, they don't produce earnings. True, they produce culture. And that's what builds the long-term value.
You reference an entire leadership course could be based on George Washington's life and pursuits because of his specific teachings and how that resonated with his troops. Do you want to explain that a little bit for?
Sure. Both George Washington and Abraham Lincoln, if you looked at the military won versus loss of their battles, they both were net losers. Now, the amazing thing is they both learned. And at the end of their careers, they were winners. Washington took care of his troops. He lived with them. Washington learned from his mistakes. He also learned how to use his allies. And he happened to be very lucky.
That always helps.
That always helps. Now, interesting point. Cornwallis, after the defeat, then went to India and had a brilliant military career. So it wasn't that Cornwallis failed. It was the other conditions. And that's how you look at things.
Well, it's the unpredictable, right? Just like we had a pandemic. Right. It was, world shut down for 2 years practically. Unprecedented.
Well, except it was predicted. I mean, that's...
Yes.
Okay. And the issue on the pandemic is, again, we did not deal with it intelligently early. Is that what I'm more concerned about is there's going to be future plagues, if you will. And we've got to organize to deal with them.
And again, I think it comes down to the leadership and what you're talking about. Somebody who is resilient and knows when to say yes and knows when to say no in terms of where that company is going and their strategy. Somebody recently said to me, no is a complete sentence. You cannot do everything, and you have to be really focused. So that leadership has to be focused. And as you're saying, focused on talent as well.
Yes. And also living the word. The CEO should be taking care of his driver. If there's a turnover in that position, that says something.
Yeah, and as we've seen in 2020 and 2021, over 10% of the S&P 500 CEOs turned over, so about 49 to 56 stepped down. And that causes disruption in a company. So before you go, because we're getting close on time, I have to ask you about blockchain and Bitcoin, and if you have views on investing in that area and where you see the future.
I have great faith in the technology of blockchain, and we are already seeing it applied successfully in non-currencies. The issue about crypto and currencies, my attitude is I don't like things that I can't sue. I always assume.
Good point, Michael.
Okay. I always assume any investment, there's a risk I'm going to have to sue. There's no case law on crypto. Now, the Fed today is talking about what are the rules that have to be in place. If they do that, that changes things. I'm perfectly willing to be late to that game. Many of the people involved in the game today are highly speculative, highly leveraged, and strong sales types.
So any parting words for our audience?
Investment is an art form. It's a year-round period where you have to be looking. Admit your mistakes and learn.
And move on. And also, I would say that individuals listening today and others should read your book, Money Wise, How to Create, Grow, and Preserve Your Wealth. And to listen to your blogs, which I've been listening to and reading, and they are just titled wonderfully and really spot on in terms of the markets today.
Thank you. Remember, I reserve the right to be wrong.
Okay, I'll remember that, Michael, as I make my investments. So, Michael Lipper, thank you so much for joining us today and sharing your incredible journey, your experiences, giving us your advice for free here. And we will look and listen to your blogs going forward because we will all need it during these turbulent times. So, and thank you to my audience for tuning in for another game-changing conversation on leadership reimagined. You can find me on Twitter, LinkedIn, or visit our website at elliggroup.com, and be sure to tune in to Michael Lipper's blogs. And Michael, where do we find your blog?
Well, actually, what you have to do is send us a note and we'll put you on a mailing list.
Okay, so where do they send the note to?
Michael Lipper at lipperadvising.com.
Okay, and if anybody has a problem with that, they can contact me at elliggroup.com. Michael, thank you so much for being with us today. We really learned so much. Thank you.
My pleasure.